Gold has been the best performing commodity this year as investors and traders flock to it as an inflationary hedge and a flight to safety asset. Joining us now to break it down is Peter Schiff, CEO at Euro Pacific Capital. So, Peter, gold is now at a 6-year high, supported by global economic fears and a widely anticipated rate cut from the U.S. Federal Reserve. While it is an inflation hedge, it is also the original negative yielding asset. Cost of carry, cost of storage, others. So do you see this rally as a short-term trend, kind of like a trading opportunity, or do you see this as a paradigm shift and more of a long-term thing?
Well, it's more likely the latter. I think it's the beginning of a much bigger long-term rise in the price of gold. And it's not just because the Fed is cutting rates, and they are. In fact, they're going to cut rates next week, and that is going to be the first step on the road back to zero. The Fed is also going to return to quantitative easing. But we just found out that Donald Trump is cutting a deal with the Democrats to basically throw out any progress the Republicans made back in 2011, thanks to the efforts of the Tea Party, to at least try to rein in the increase in government spending. So they're throwing caution to the wind. We are going to see deficits going through the roof over the next several years, and that's even without the recession, which I believe is coming and which is going to make them much, much worse. So bigger deficits mean much more money printing. They mean a lot more inflation. And all of this is very bullish for gold. Even though gold was down today, if you really understood what this means, you would be buying gold as fast as you can.
So what is the next level for gold here? We see it holding steady, kind of little dipping today, but the next level resistance looks to be around the 1590 area. Is it going to punch through there before the Fed rate cut, or is it going to settle down for a bit?
Well, the Fed's cutting rates next week, so it's not probably going to do it before the Fed cuts rates, but I don't think it's going to take too much longer for that to happen. I don't really see much significant resistance until you get up around 1800, 1900, the vicinity of the 2011 high. And coincidentally, you know, gold peaked out just as the U.S. government was taking some steps to rein in deficit spending. Well, now that we've eliminated those steps, it makes sense that gold would break out. And so I don't think that that level is going to offer any real formidable resistance. It may be a temporary resistance, but ultimately the price of gold is going to shoot past the 2011 highs, and who knows how much higher it's going, but much higher.
Right. And Peter, speaking of gold and the Federal Reserve, Judy Shelton, the presumed next Trump nominee for the Fed board, is a supporter of returning to the gold standard, which I know you're in favor of, but also has called for a rate cut, which you've been very critical of. What's your take on this sort of heterodox combination of positions we're seeing from Judy Shelton?
Yes, you know, there are a lot of Republicans that have taken this hypocritical position. If anybody actually believes in a gold standard, then they believe that the market, not the Fed, should be setting rates. And if the Fed were allowed the market to set rates, rates would be much higher. The only reason rates are as low as they are is because the market is anticipating how the Fed is going to react in the next recession, which is quite imminent. So I think it's wrong. If Judy Shelton really wants to return to a gold standard, then she wants higher interest rates, because higher interest rates is what we would get if we went back on a gold standard. And that would be a good thing, because that's what the economy needs. We don't have enough savings. We don't have enough capital investment. We have too much borrowing on all levels. And that's because the Fed has held interest rates artificially low. So if the Fed can no longer do that, then rates are going to rise, at least in the short run. Now, in the very long run, over the long term, we get lower interest rates on a gold standard than we will on the standard we have now. But that's because we have sounder money, less inflation, and higher savings. But the government has been able to manipulate interest rates artificially lower to boost the GDP, to pop up the stock market and other asset bubbles. But all that's going to blow up, and interest rates are going to go sky high.
Peter Schiff of Euro Pacific Capital, thanks for your insight.
My pleasure.